Okay, so you want to start a construction company. Buy a van, hire a couple of tradesmen, put a sign on the side of the vehicle, and watch the contracts roll in. That is the plan in your head. And on paper, it looks almost too simple. Drive past any building site on a weekday morning, and it looks like the easiest business in the world. Scaffolding going up on one street, a loft conversion on the next, a new housing estate rising out of a muddy field a few miles away. You watch that and you think, everyone needs building work done. This must be a license to print money. Here is the problem. You are looking at the one part of this industry that lies to you the most. The truth is that a construction firm is not really a building business. It is a cash flow business that happens to involve bricks and concrete. And once you understand that difference, everything about how a construction company makes money and how it quietly goes bust while its sideboards are still standing starts to make sense. Let us start with what it actually costs to get this business moving. Because the entry price is a lot more layered than a van and a toolbox. There is not one type of construction firm. There are several, and each one is really a different business wearing the same high-vis jacket. At the small end, you have the sole trader or micro firm, one or two tradesmen doing kitchen extensions, driveways, and small refurbishments, usually turning over somewhere between 50,000 and 200,000 pounds a year. Above that sits the small to medium contractor, the firm that takes on loft conversions, house extensions, and small commercial fit-outs, typically employing 5 to 20 people and turning over between £500,000 and £5 million. Above that, the regional main contractor, the firm bidding for housing developments, school builds, and larger commercial projects, often turning over £10 million or more, and working almost entirely through subcontractors rather than direct labor. And then there is the specialist trade contractor, groundworks, roofing, electrical, mechanical services, the firm that never touches a full building from start to finish, but is essential to every single one of them. Each of these is really a different bet on the same underlying question. Do you make your money by controlling the whole project and carrying all of the risk? Or do you make your money by controlling one small slice of the project and passing most of the risk somewhere else? That single decision shapes almost every other number in the business. Now here is where the naive mental model starts to break down. You think the expensive part is the tools and the materials. It is not. The expensive part is proving to everyone else in the supply chain that you will still be solvent in 6 months' time. Public liability insurance for a construction firm typically runs between £1,000 and £5,000 a year, depending on the type of work. Employer's liability insurance is a legal requirement the moment you take on staff, and that adds another one to £3,000 a year. Then comes professional indemnity cover if you are doing any design work, which can add several £1,000s more depending on the size of the projects you are bidding for. None of this builds you a single wall. It simply allows you to legally exist in the eyes of a client. On top of that sits the part almost nobody budgets correctly for at the start, which is bonding and retention money. Larger clients, particularly local authorities and main contractors, will typically hold back a retention of 2.5% to 5% of the contract value, sometimes for up to 12 months after the work is finished, specifically to cover any defects that show up later. That means, on a £200,000 contract, you might not see the final £5,000 to £10,000 of your own money for a full year after the job is complete. Add up insurance, bonding, vehicle costs, a small stock of tools and plant, initial marketing, and a cash reserve to survive the gap between starting work and actually being paid for it. And even a modest small to medium contractor can require £30,000 to over £200,000 just to get properly trading, long before a single brick has been laid on a paying job. So far, so good. Now let us talk about what can go wrong, because the next trap is bigger than most first-time owners expect, and it lives inside a single word: retention. This is not the retention money the client holds back from you. This is the money you have to hold back or pay out to your own subcontractors and suppliers. And the mismatch between the two is where a huge number of construction firms quietly bleed to death. Here is the mechanism. Your client might pay you on 60-day terms. Your subcontractors, the bricklayers, the electricians, the plasterers, often expect to be paid on 30-day terms or sooner, because most of them are small operators who cannot survive a long wait either. That means for 30 days on every single contract, you are effectively funding the project out of your own pocket. You have paid your subcontractors, but your client has not paid you yet. Scale that across 5 or 6 contracts running at once, and a firm that looks busy and successful on paper can be sitting on a genuine cash crisis. Not because the work is unprofitable, but because the timing of the money does not line up. This is, without exaggeration, the single most common reason construction firms in the UK fail. Not a lack of work, a lack of cash at the exact moment it is needed, even while profitable contracts are sitting half-finished on multiple sites. Now let us talk about equipment, because this is where the buy versus hire decision becomes almost a philosophy of how you run the business. A mini digger can cost £40,000 to £70,000 to buy outright. A tower crane can run into hundreds of thousands. Scaffolding, generators, dumpers, cement mixers. The list is long, and for most small and medium firms, plant hire is the more common route, typically costing anywhere from £100 to £1,000 a week depending on the machine. Buying feels safer. You own the asset. There is no ongoing rental bill, and you can use it whenever you like. But buying locks up capital in a machine that might sit idle for weeks between projects. And it exposes you to depreciation, maintenance, and the risk of a piece of equipment breaking down mid-project with no backup. Hiring keeps your cash free and lets you match your equipment costs to your actual workload. But it means every single week, a machine sits on a live site. Money is leaving the business, whether or not the crew is actually able to use it that day, due to weather, delivery delays, or a change in the schedule. Neither choice is wrong, but whichever one you pick, you have locked in a cost that behaves very differently depending on how smoothly the project runs. And in construction, projects rarely run exactly to plan. Now, location and specialism. This is the decision most first-time construction business owners underestimate, because they assume more available building work nearby automatically means more opportunity. It is more specific than that. The type of work available in a region has to match the type of firm you have built. A firm specializing in high-end residential extensions needs to be operating in an area with enough disposable income to actually commission that kind of work. A firm built around groundworks and volume housing needs to be near active development land and established relationships with the larger house builders, because that work is won through long-term relationships and repeat tendering, not walk-in customers. And crucially, construction is one of the most cyclical industries in the entire economy. Interest rate changes, mortgage approval rates, and government infrastructure spending can each swing the volume of available work up or down within a single year, often with very little warning. A firm that built its entire pipeline around one type of client, say private housing developers, can watch its order book shrink dramatically the moment interest rates rise and mortgage approvals slow down, even while the firm itself has done nothing wrong. Now we get to the part of this business that actually explains everything else, and it is the subcontracting model itself. Picture two different ways of running the exact same construction firm. In one version, you employ every single tradesman directly, on your own payroll, all year round. In the other version, you employ a small core team and bring in subcontractors for almost everything else, only when there is confirmed work to give them. Which of those two models is more resilient? It is the second one, and this is the single most important structural idea in the UK construction industry. Here is the math behind it. A direct employee costs you a salary every single week, whether or not there is work for them to do that week. Add employers' national insurance contributions, holiday pay, sick pay, and pension contributions. And a direct employee typically costs the business 20 to 30% more than their headline wage. A subcontractor, operating under the construction industry scheme, only gets paid for the work they actually do, and only when there is work available. If a project is delayed by bad weather, a late delivery, or a planning issue, a subcontractor simply is not booked that week, and the cost disappears with them. This is why the UK construction industry runs overwhelmingly on subcontracted labor, with independent data consistently showing that a very large share of people working on UK construction sites are operating as self-employed subcontractors rather than direct employees of the main firm. It is not because construction firms do not value loyalty or long-term relationships. It is because the entire industry runs on projects with uncertain timelines, and a workforce that can expand and contract with the workload is the only way to survive the inevitable gaps between one job finishing and the next one starting. There is a seasonal wrinkle to this whole picture too, and it shapes the entire financial calendar of a UK construction firm. Winter months bring shorter daylight hours, wetter weather, and a genuine slowdown in the pace certain types of external work can progress at, particularly groundworks, roofing, and anything reliant on concrete curing in reasonable temperatures. Many firms see a noticeable dip in productivity and new contract starts between November and February, and experienced owners plan their entire cash flow around this, treating the busier spring and summer months as the period to build a reserve that carries the business through the quieter winter stretch. The owners who get caught off guard are the ones who staff up and spend as though the summer pace of work were the permanent baseline, rather than the seasonal peak that it actually is. There is also a structural choice sitting underneath all of this, and it is the tender versus relationship decision. Public sector and larger commercial contracts are typically won through a formal competitive tender process, which means submitting a detailed costed proposal against several competitors, often for a project that will not start for months. Winning through tender gives you access to larger, more prestigious contracts, but it also means competing largely on price, and the process of preparing a serious tender submission can itself cost a firm several £1,000s in staff time, with no guarantee of winning the work at all. Private residential and smaller commercial work is far more often won through relationships, referrals, and reputation, which carries a much lower cost of winning the work, but typically comes with smaller, less predictable contract values. A firm chasing scale usually has no choice but to compete for tendered work eventually, and that shift changes the entire risk profile of the business. Because tendered contracts are frequently fixed price, meaning if material costs rise or the project runs longer than expected, the firm absorbs that extra cost itself rather than passing it on to the client. Now, here is where the financial fragility becomes just as important as the revenue figures. Why do so many well-known, seemingly busy construction firms suddenly collapse? The UK has seen this pattern repeat itself at real scale. One of the starkest examples is Carillion, once one of the largest construction and services firms in the country, holding major government contracts across hospitals, schools, and infrastructure projects. On paper, the model looked secure. enormous contract backlog, government relationships, a huge order book. But the company collapsed into liquidation in January 2018. And the reason was not a shortage of work. The reason was structural. The firm had taken on low-margin contracts to keep its order book looking impressive, had built up significant debt, and was stretching payment terms to its own subcontractors far beyond what those smaller firms could survive, sometimes over 100 days. When the underlying cash position could no longer support the debt and the deferred payments, the entire structure gave way almost overnight. And thousands of smaller subcontractor firms who were owed money were left exposed, with some of them going under as a direct result. The lesson is not that people stopped needing construction work done. The lesson is that a firm with an enormous, visible pipeline of contracts can still be one cash flow mismatch away from insolvency. And the size of the order book tells you almost nothing about whether the underlying financial structure can hold. So how does a construction firm actually make money in plain mechanical terms once you strip away all of this? The core engine is simple. Contract value minus materials minus subcontractor and labor costs minus overheads equals gross margin. In the UK, typical gross margins for small to medium contractors sit somewhere between 15 and 25% of contract value. But net profit margin, after overheads, insurance, finance costs, and everything else, usually lands much lower, often somewhere between 2 and 6% for the industry as a whole. That is a genuinely thin margin, which means a single underestimated project, one unexpected delay, or one client who is slow to pay, can be the difference between a profitable year and a loss-making one. This is precisely why cash flow management, not just profitability on paper, is treated as the single most important skill in running a UK construction firm. A firm can be contractually profitable on every single project it has and still run out of cash and fail, simply because of the timing gap between paying subcontractors and being paid by clients. Now let us put all of this together and look at what actually happens over a full year. Because this is where the two very different versions of this business reveal themselves. In the optimistic scenario, you have built strong relationships with reliable clients who pay on time, kept your subcontractor network flexible enough to scale with demand, avoided taking on fixed-price tender contracts during a period of rising material costs, and managed your retention money carefully across multiple projects. Under those conditions, a small to medium UK construction firm turning over £2 to £5 million a year can generate a net profit margin toward the higher end of the industry range, translating into an owner's take-home that genuinely reflects the risk and the long hours involved in running the business. In the realistic scenario, 2 or 3 things go wrong that are not exotic at all. They are the normal risks of this exact industry. A large client stretches their payment terms from 60 to 90 days without warning. Material costs for steel or timber rise sharply mid-project on a fixed-price contract you already signed. A key subcontractor becomes unavailable partway through a job, forcing you to bring in a replacement at a higher day rate. Under those conditions, that same firm can slide from a comfortable margin into a break-even year, or into an outright loss, even while its site boards are still up and its order book still looks healthy from the outside. And almost none of that swing shows up as a single dramatic event. No collapsed building, no scandal, just a slightly longer payment cycle, a slightly higher material cost, and a slightly heavier retention balance, compounding quietly month after month until the number at the bottom of the accounts looks nothing like the plan. So if you do decide to start a construction firm in the UK, remember the one thing that actually determines whether you survive. It was never really about how much work you can win. It is about how well you can manage the gap between the moment you spend the money and the moment you actually get paid for it. If this kind of breakdown helps you see a business differently, that is exactly what this channel is built around. Subscribe to Money Framework British for more deep dives into how everyday businesses really make their money behind the scenes, and turn on notifications so you never miss the next one.